Hey, good afternoon, everybody. Uneducated Economist here. So, got a great interview here out of the Bureau of International Settlements with Claudio Borio. And I don't want to read you the whole interview, but I wanted to give you some highlights here that I thought were just really, really good. So the question here, the policies of the central banks, however, do have side effects. You already warned against a debt trap. Are we already caught in that debt trap? And Claudio goes on to say, it's too difficult to say. What I can say is that if debt levels increase further, it would become more difficult for central banks to raise rates again without creating problems. Principally, central banks should use good economic conditions to tighten monetary policy, preferably with a steady hand. Moreover, they should not be deterred by short-term market volatility as long as that volatility does not have a significant impact on the real economy. So what he's saying there is that what I can say is that if debt levels increase, right, if people keep going deeper into debt, it would become more difficult for central banks to raise rates again without creating problems. So what he's saying is that if they do not deal with the problem right now, come the future, they're going to have a hell of a time trying to deal with it. And then the next question, you are worried by the U.S. corporate debt market? Why? And he goes on to answer. First of all, this market is interesting because it illustrates the developments I outlined earlier. In the U.S., households, which were at the core of the crisis, decreased their debt while corporates, which were less affected, increased it. We are not the only ones who have warned about U.S. corporate debt. We are worried, for example, about the market for leveraged loans given to highly indebted companies. This market has grown massively and has a volume of some $1.3 trillion. Okay, so if you didn't quite catch what he was saying there, is they're worried about the U.S. corporate debt. And what he was saying is during the last financial crisis, the problem was household debt. Right? But he's saying that's kind of decreased over the last few years, and the bigger problem is the corporate debt. And it's not just that corporates took out a lot of debt, is that people went and borrowed money to loan money to these corporations, and that's what he is kind of going on about. He says, for example, about the markets for leveraged loans given to highly indebted companies. So yeah, so he's saying that not only are these corporate debts are they got way too much corporate debt out there, that the people who gave that debt to them, like basically loaned money to these corporations, borrowed the money to do it. All right? And then it goes on to say here, the question is, U.S. bonds with a BBB rating already have a volume of $2.25 trillion and make up 75% of the U.S. investment grade market. Can this giant market cause a recession? That's the big, and then he goes on to answer. That's a big word, cause a recession. I would rather say reflect or contribute to a recession. If the world economy slowed down substantially, or if there was a recession, it is likely that the rating agencies would downgrade significant parts of this market to junk. That would widen the credit spread sharply, so risk premium for corporates would rise. Corporates would have to pay higher rates for the new money, and some might even lose access to funding altogether. This would amplify market reactions. So what he's saying there is that if the U.S. government debt was to be downgraded from the BBB down to a junk status, the corporate level debt is going to explode, right? The interest on this corporate level debt. And it's saying basically that it would get to the point that, the interest rates would be so high that the corporations may have trouble just even finding the ability to even borrow money to begin with. Right? And then it goes on to say, what could trigger this dynamic? And this is what he goes on to answer. Many investors are not allowed to hold junk bonds. Okay? Remember that, guys. So they would have to sell depressing prices and pushing up yields, and hence companies' funding costs. So if you didn't quite get it right there, if these, a lot of investors, say guys for pension funds and just different, investments out there, especially if people are investing money for other people, they are required to invest into a certain grade of investments, okay? And this BBB is at the bottom of the line, and if it goes any less than that, then they can't have these investments. They have to unload those things. And that's where he is saying many investors are not allowed to hold junk bonds, so they would have to sell, depressing prices and pushing up yields, right? So if they're dumping these out there, and there's a lot of these corporate bonds out there, for sale, the new corporate bonds going on there are going to have to pay a higher interest in order to attract a buyer. And that's what he's saying there, pushing up yields and hence companies' funding costs. So he goes on to say, And then he goes on to even talk a little bit more about ETFs, right? And he says such ETFs are part of an overall boom in asset management underpinned by very favorable conditions. In such a situations, investors often tend to take increased risk. So he's saying that even these investors who are invested in stuff, a lot of them didn't invest in the actual product. They went and bought ETFs, right? The exchange traded fund, which is a way to get yourself exposure to a particular investment, but it's not actually owning the investment itself. It's an ETF, it's an exchange traded fund. So basically you're going to a group of people who say they have the fund and that you can buy into it with an ETF. Problem with that is that these things are really liquid during good times, but when situations change, ETFs become very illiquid because you can't seem to sell them on the market as easily as you could during the booms. And he says that here. However, fair weather liquidity disappears rapidly when market runs into difficulties, and he's talking about the ETFs there. Goes on to say, one could argue that there are problems in the corporate bond market. Central banks could step in by printing more money to cushion any difficulties. How realistic is that? And he goes on to say, central banks would naturally respond if the problems in the market threatened economic activity. However, the question is whether that would be enough. History suggests that it might not be. This is part of the broader issue. The nature of business cycles has changed since the 1980s. Until then, recessions were caused by central banks reacting to sharp increases in inflation by tightening monetary policy. Since then, the origin of recessions has been in the financial sector, as unsustainable financial expansions have largely self-corrected with large change in inflation. So if you didn't quite get that there, prior to the 80s, the any time that they would see, like central banks would start seeing this bout of inflation, that's when they would start raising interest rates in order to, combat or in order to stifle that inflation, and that would send us into a recession, okay? What he's saying now there, though, is that things have changed, right? Since then, the origin of recessions has been in the financial sector, as unsustainable financial expansions have largely self-corrected with little change to inflation. So what he's saying there is that the recessions aren't caused by the central banks trying to bat off or trying to stave off inflation. It's caused by too many people taking out way too much debt, and then they can't afford to pay the debt, and then down goes the economy. Let's see here. And then the very last part here that I'm going to give you, it says, but is there some way out of debt? And it says, of course, there are three possible ways, but only one and a half of them works. The first way out is higher inflation combined with interest rates that stay low, a form of financial repression. This combination would erode the value of outstanding debt, make it easier for borrowers to repay it. However, as history tells us, high inflation leads to lower growth. We've been there. We've seen that, and we don't want to go back. Second way is to restructure debt. This would be painful, as investors would incur serious unexpected losses. Targeting restructure can be a part of the answer, but only to a limited extent, okay? The best way to get out of debt is stronger, more sustainable growth. Higher income would lead to a lower ratio of debt to GDP. So basically, three ways out of debt. One, you can try and inflate your way out of debt, and he says that's not good. We've been there, we've seen that, we don't want to go back. The second way is to restructure debt. This basically means that everybody who is invested in bonds and corporate debt or whatever, they're going to have to get hacked, right? That means they're not going to get back their principal plus an interest. They're only going to get back a little piece of the dollar, some pennies on the dollar of what they've invested. The third way is targeted as the best way to get out of the debt is stronger, more sustainable growth. Well, how do you do that? And the answer is with higher income, right? So we've already seen how incomes have really stayed up to date with the cost of everything out there. Certainly doesn't seem to be in our future getting high enough wages to combat all the debt that's out there. So I don't really see that being the answer. The other two suggestions don't really seem that feasible either. So I don't think there is a way out of that debt, right? Uneducated Economist. Talk to you guys later.